what the road ahead for your money might look like with earnings season about to get underway and so much more ahead as well. Let's ask AJ Oden, JPMorgan Private Bank Global Investment Strategist, with me here at Post 9. It's good to see you. Welcome back.
Good seeing you too, Scott.
Interesting move we are seeing today in the market after a pretty rocky road last week. What do you make of how this year started?
Well, I think the way that this year started is we saw a lot of optimism priced in last year in those last 2 months, November, December. And then when you add to the fact that the Fed sort of came out with their SEP, adding in a little bit more rate cuts, what we've been seeing lately is the market's really trying to figure out how many cuts we're going to have this year. And for us, we believe that equities will see all-time highs at the end of 2024. And the reason for that is we believe that technology will have a pretty strong year, and that'll sort of add to that tailwind that we're seeing in equities into the end of the year.
All right, so a couple of things there. Number one, rate cuts. When do you think we're going to get the cuts? Do you think we're going to get as many as the market has seemingly priced in to this point? And is that the reason why you think we're going to new highs? Just don't fight the Fed.
Well, I think the market is priced in a little bit too much optimism. 6 rate cuts, I think, is what we're seeing priced in. And I think the expectation is about 50% for a March cut. We believe it probably won't see it until like June, but we're not taking March completely off the table. We're looking at about 125 basis points of cuts.
Okay, now technology, that's the interesting conversation. Do you think that is going to be the leadership group yet again?
I don't necessarily think it's the leadership group, but we think investors should continue to lean into technology stocks, especially driven by AI. And so I know everybody saw a lot of that optimism last year, but if we think about it, if we go back to the peak of technology in 2021, and we look at where tech stocks are today, the Magnificent Seven, they're actually only 7% above the peaks that we saw before. And so if you think about that, 2021 hadn't even priced in the AI move. And so if we think about AI and what we saw from the mid to late 90s and the contribution of private investment in intellectual property and how that contributed to steady growth in GDP, if we see that similarly in AI, then we believe this is a multi-year, this is not just a one-year trend.
So you believe that the multiples that they're currently trading for are justified?
Yes, I think so. I think that there's an opportunity for continued growth, and that the comps compared from last year for earnings, that we should see some positive earning results from those technology companies, and we see some top-line revenue results as we believe that essentially a lot of that AI investment will turn to revenue generation soon.
What about non-tech areas? What do you like the best?
Well, I think healthcare looks attractive as well, just from a valuation standpoint. We really like industrials just because of the fact that when you start to look at some of the thematic trends of EV transition, the infrastructure bill that's going to be needed there, we like mid-cap growth as a way to position there.
So are you looking then, you're definitely in the no recession soft landing camp?
Yeah, we're definitely in the soft landing camp. And I think because of the fact that we've seen inflation come down meaningfully without too much pain in the labor market. We've seen the quits rate return back to pre-pandemic levels. It's around 2.3%. We've seen job openings fall from that peak back in 2022 down about 3.2 million. And we've seen all that happen and inflation come down. If we look at back to the past 6 months, we're tracking around 3%. And then if you look at over the past 3 months, you're tracking close to 2%. So the Fed has some room to start cutting. The Fed put is definitely back in play.